Welcome everyone. Today we are going to discuss on the topic auditing. First, meaning of the auditing. The origin of auditing may be traced back to the 18th century when the practice of large scale production was developed as the result of industrial revolution. It is found that some systems of checks and counter checks were applied for the purpose of maintaining public accounts, rather accounts of public institutions, as early as the days of the ancient Egyptians, the Greeks, and the Romans. The history of auditing in India dates back to April 1, 1914, when the Indian Companies Act 1913 came into force. The Act for the first time prescribed the qualifications of an auditor. Next, definition. According to Spicer and Begler, an audit may be said to be such an examination of the accounts, books, and vouchers of a business as will be enable the auditor to satisfy that the balance sheet is properly drawn up so as to give a true and fair view of the profit or loss for the financial period. According to the best of his information, the explanation given to him and as shown by the books, and if not, in what respects he is not satisfied. According to ICAI statement on standard auditing practices, auditing is the independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. Therefore, audit may be defined as a systematic and scientific examination of the books of accounts of a business, which is done by an independent person or body of persons qualified for a job. With the help of vouchers, documents, information, and explanation received for the authorities so that the auditor may satisfy himself with the authenticity of financial accounts prepared for a fixed term and ultimately report that the balance sheet exhibits the true and fair view of the state of affairs. Profit and loss account reveals the true and fair view of the profit or loss for the financial period. And the accounts have been prepared in conformity with the law. Next comes the duties of an auditor. The auditor's main duty is to check the arithmetical accuracy of the accounts. He also wants to check the books of accounts with the help of all the relevant vouchers, invoices, correspondence, minute books, etc. His duty is to verify profit and loss account and assets and liabilities in the balance sheet, whether it shows the true and fair view. His duty is to report to the client on the basis of his findings. These are the duties of an auditor. Next comes features or characteristics of auditing. It is the systematic and scientific examination of the accounts of a business. It is an intelligent and critical examination of the accounts of a business. It is done by an independent person or body of persons qualified for the job. It results in the verification of profit and loss account and the statement of affairs shown by balance sheet. It reviews the critical system of accounting and internal control. It is done with the help of vouchers, documents, information, and explanation received from the authorities. Next comes the objectives of an audit. The objectives of an audit is of two types. First one is primary objective and the second one is secondary objective. The primary objective of an audit is to find out whether the accounts of a particular concern exhibit a true and fair view of the earnings and financial statement of affairs. It helps to see whether the accounts are complete, correct, and in conformity with the law. The secondary objective is of two types. One is detection of errors and fraud, and the another one is prevention of the recurrence of those errors and frauds. The secondary objective in that first one, detection of errors. The errors may occur because of the carelessness of the staff or their ignorance of the principles of accounts. This error may be of the following types. The first one is clerical or technical errors. That is error of omission. When any transaction is omitted fully or partially, it is known as error of omission. Error of duplication is nothing but a transaction has been recorded twice. Error of commission means incorrect records in books of accounts. When an error counteract with each other, then it is known as compensating error. The second type is error of principle. These errors arise when transactions are not recorded in books according to fundamentals and accepted principles of accountancy. Next comes the detection of frauds. Frauds connected with the accounts may take place either by misappropriation of cash and goods or by falsification of accounts without any misappropriation. This misappropriation of cash may take place in two ways. One is by omission of receipts and acknowledging a lesser amount than actually received. And the another one is by inclusion of fictitious payment or recording more payments than actually made. The second one is misappropriation of goods. In case of goods which are less bulky but more valuable or greater in misappropriation of goods. Next one is falsification of accounts. This is to conceal the true position of the concern. The next is prevention of errors and frauds. How the errors and frauds can be prevented. Prevention of errors and frauds is possible only by the application of sound system of internal check and efficient management of the concern. Such moral check is imposed on the employees of the client automatically, since they would be always alert and would not carry on any dishonest transaction. He should make the detailed study, analysis and evaluation of the internal control system of the enterprise and find out its weakness. By these ways, the errors and frauds can be prevented. Next topic is types of an audit. There are various types of audit such as based on organizational structure. In that, statutory audit, non-statutory audit and government audit. The non-statutory audit is further classified as private audit, which includes sole proprietorship, partnership and non-profit organization. The next one is based on scope. In that, complete audit, partial audit and detailed audit. Next, based on time. It is classified into continuous audit, final audit and interim audit. Based on the object, special audit, cost audit, management audit, internal audit, social audit, tax audit, proprietary audit, environmental audit. On the basis of organizational structure, statutory audit. Statutory audit is a compulsory audit prescribed under statute, that is, comes under law. The appointment of auditors, removal, remuneration, rights, duties, and liabilities are governed under the provisions of the respective law applicable to the organization. The scope of the audit work and all others terms as laid down by the law. It can be conducted only by a qualified chartered accountant. The statutory audit is conducted after preparation of final accounts. He has to report whether the balance sheet, profit and loss account are drawn upon conformity with law and whether they show the true and fair view. The statutory auditors has to report to the statutory auditor's duty is to submit report to the shareholder. His remuneration is also fixed by the shareholder. Next comes government audit. A government maintains a separate department in the name of account and audit department which performs the audit of its different department and offices. This department is headed by the Comptroller and Auditor General of India, who is assisted by the different officials at various levels. They are meant for government departments. They will work according to the rules and regulations of the department. The government audit's objectives are: the main objective is to ensure that the expenditure is incurred out of the fund which has been sanctioned by the competent authority. And the government audit must verify that the expenditure of the government department is sanctioned in accordance with the rules and regulations of the department concerned. And this audit should see that the expenditure already sanctioned has been incurred by an officers who are authorized. And his duty is to ensure that the payments have been made to the right person and it is duly entered in the books on the basis of receipts received by them. To see that the payments have been properly classified as whether capital or revenue. If the payment has been made to an individual against some accounts under the rules and it is to be recoverable, it has been recorded in the account prescribed. While vouching receipts, it is to be ensured that such receipts are against payment which have been made and recoverable as such. They are also recorded in the prescribed. The next objective is to verify the existence and valuation of stores and the stock. You must ensure that the proper system of stock taking has been adopted. To check the system of granting allowances such as traveling allowance, daily allowance, etc. to ensure that have been granted under rules framed for the purposes. Next one is non-statutory audit. Non-statutory audit is a voluntary audit. They are not compulsory and it is carried at the discretion of the proprietor terms and conditions of the audit. For example, financial audit of a sole trader and a partnership firm is a best example for non-statutory audit. This voluntary audit also covers non-financial audit like internal audit, management audit, social audit, operational audit, etc. Next comes the private audit. The private audit is done in the institutions which are private in character, also gets their accounts audited by some qualified auditors. Such an audit is not required by statute. So it is known as private audit. These bodies have their own arrangements for audit and run for their own interest. So their accounts may be subject to close scrutiny to be made by a professional accountant. Next, the next type is based on scope. Complete audit. This type of audit, the auditor is required to check each and every transaction recorded in the books of account. He has to examine every voucher, document, or correspondence relating to the transaction. This type of audit is not possible for large sized organization. Next comes partial audit. In this, the auditor is not required to examine all the books of accounts. Only a part of the accounts or some transactions as decided by the clients may be scrutinized. This type of audit cannot be followed in the cases of statutory audit. Next comes detailed audit. Few business transactions are examined in the detail by the auditor. Next, auditing based on time. And that first one is continuous audit. This continuous audit is done constantly or at regular intervals, engaged in checking the accounts during the period. Continuous audit means an audit done continuously throughout the accounting year. The audit work begins after the accounting period is over. But in case of continuous audit, the work begins the accounting year itself. For example, if the accounting year begins on the 1st April and ends on the 31st March, normally the audit work would in April 2003 and continue thereafter. But in case of continuous audit, the work would begin in the April itself and continue at regular intervals till it is complete. Thus, in continuous audit, accounting and auditing work is done almost side by side. Next, auditing based on time. Final audit. Generally, it starts after the close of the financial period. There is very little impact on prevention of errors and frauds by way of moral checks. It is best suited for small and medium-sized business. It serves in term of time, energy, and money. Next, interim audit. Interim audit is an audit conducted in between the annual audits. It is conducted to find out the interim profit and know the financial position at the end of the part of the financial year. For example, an audit of accounts prepared for the period of 6 months from April to September would be interim audit. Next, based on object. First one is special audit. The central government has power to order a special audit of accounts of a company for a specific period. This is under section 233A of a Companies Act 1956. Special audit is ordered without providing an opportunity to the company whether the central government is of the opinion when affairs of any company are not managed as per the sound business principles. When company is being managed in a manner which is likely to cause serious injury or damage to the interest of trade or industry. When financial position of a company is such as to endanger its solvency. Next one is cost audit. It is a type of audit which involves verification of cost records maintained by the organization. The central government may direct an audit of cost records by a person who is qualified. Appointment of auditor is done by the board of directors. subject to the approval of the central government. The auditor reports to the government and the copy of the report is sent to the company. In cost audit, it is prescribed certain types of industries with a view to achieve the objective to grant the price concession of the company and to fix selling price and to safeguard interest of customers and to consider the question of production of the company and to ascertain the causes of loss suffered by the company. And the next one is management audit. It involves examination of the plans, policies, procedures, methods and strategies and evaluates the performance of management with a view to improve organizational effectiveness. It does not look into the past, present, but also in the future. Next is internal audit. This auditing is a continuous critical review of financial and other operating activities by a staff of auditors functioning as full-time salaried employees. According to ICAI, internal audit is an independent appraisal activity within an enterprise for the review of accounting, financial and other operation and controls as the basis for service to management. It involves a specialized application of the techniques of auditing. Next one is social audit. A social audit is a recent development in the field of auditing. It is based on the modern concept of social responsibility. It examines to what extent the business is discharging its social responsibilities. It also examines the contribution of the concern to the society. It reviews and evaluates the performance of the concern in the following areas. The first one is contribution to natural economic growth. The second one is for welfare of the employees. And the third one is product relations. The fourth one is care for environment. The next one is tax audit. The new concept of tax audit has been evolved lately under the Income Tax Act 1961. In India, it provides for compulsory audit of accounts of certain assessees whose turnover or receipts exceed for specified limit. The account are required to be audited for determination of tax payable by an individual assessee or organization. Next one is other types of audit. In that, first one is environmental audit. In recent times, new type of audit has emerged and it is known as environmental audit. The main objective of this audit is to examine the effects of the activities of the organization on environment. It is a tool comprising a systematic, periodic and objective evaluation of how well organization, management and equipment are performing to safeguard the environment. Next one is propriety audit. The propriety audit not only examines the transaction from the books of accounts with the help of vouchers and documents, but he also verifies how far transaction affected from the decisions or actions are proper or reasonable. The property audit is concerned with the examining that there is no leakage of revenge or wastage of funds by mistake or fraud. It is concerned with ascertaining appropriateness from legal, financial or economic point of view. Thank you.